Hey guys, it's a new month, so you know the drill. I'll share our Tfsa dividend income for the last month of the year. At the end of the video, we'll look at our total dividend income for 2022 and how it breaks down. Let's do this. Before I jump into who paid us and how much, let's glance at our portfolio's dividend calendar. January, April, July, and October are the heavy months, and February, May, August, and November are the light months. The other months land somewhere in the middle. In December, we receive dividends from the following 9 stocks. Like usual, we'll go through each paycheck we received, adding up our totals along the way, starting with the smallest payer. Our OG utility, Fortis, paid us $66.11 in December, down from $72.77 in the last quarter. This gives it a weighting of 3.9% of our yearly dividend income. Fortis has been a stable and steady grower over the years, with price growth and dividend growth both around the 6% mark. Right now, it is yielding 4.1%, which is above its 5-year average yield. The stock price ended the month pretty much flat. At this price level, I have my drip turned on and enjoy the cheap accumulation of shares. I hope the share price drops a bit more so the stock hits my rule of 12 I go by. The longer this stays below 12, the more it will impact long-term dividend growth. Fortis finished the year down 7.7%, including its dividend. Better than the S&P 500, but worse than the TSX. If you haven't already done so, you should totally follow me on Blossom Social. You'll be able to see exactly when I buy, what I buy, and at what price I buy. And sometimes I even share my rationale for why I purchase one stock over another. All you have to do is click the link in the description below. Next up was our smallest dividend payment of $23 from our one closed-end investment fund, Canoe EIT Income Fund. It provides us with 4% of our yearly dividend income. EIT has consistently paid out 10 cents a month for as long as I've owned it. The more the years go by, the harder it is to get rid of this income fund because of how well it has performed. I have no intention of increasing this position for more income. I only focus on dividend growth stocks. This finished the year up 10% including its distribution, killing it yet again. And we are just shy of the $100 mark at $89.11. Next, we were paid $72.27 in dividends from Manulife Financial Corporation. This is down from $96.69 in the last quarter. You can start to see how selling off that chunk of our portfolio is affecting our dividend income. MFC provides us with about 4.2% of our annual dividend income. This has become a core holding in our portfolio for a long time now. They continue to grow their dividends at a rate of 9.6% over the last 5 years, with a massive 17.9% raise at the end of 2021. It is currently trading at a PE of 6.5 and a yield of 5.5%. The share price has been stagnant for years now and finished the year completely flat. This doesn't bother me one bit in the accumulation phase of investing. I'm anticipating a small dividend increase announcement in the first quarter to keep their streak going. After 3 paychecks, we're at $161.38. Our next dividend received was $71.34 from a monthly payer, Pembina Pipeline Corp. It pays us 6.2% of our yearly dividend income as one of 3 in the oil and gas midstream pipeline industry. You may have noticed this is a much higher payment than usual. That is because PPL paid out twice in December, as it will be moving to a quarterly payment next year. Pembina Pipeline is trading at its 5-year average yield of 5.7% after pulling back in price. It recently raised its dividend 3.6%. It has a 5.8% 5-year CAGR on its dividend. It is trading down about 8% on the month. Pembina Pipeline has outperformed the market drastically, up an incredible, and I mean incredible, 26% on the year, including the dividend, of course. With the economy just starting to putter, it looks like oil and gas may start its downtrend. China opening up from COVID may be the wild card here. Let's see how long the oil cycle holds out for. With this paycheck, we're at $232.72. Our next paycheck was $113.95 from Fiera Capital Corp, almost $30 less than last quarter. They provide us also with 6.6% of our yearly dividend income. They are currently trading far above their average yield of 7% over the last 5 years. In 2021, there was a tiny 2.4% dividend raise. This is a high-risk, small-cap holding that was performing well for some time. I wanted to accumulate more during the 2020 crash, but now I'm happy I held off, as I'm losing confidence that they will be able to continue to grow their income in these turbulent market conditions. I'm monitoring Fiera Capital very carefully. They have been on the chopping block for some time now. Fiera finished the year with a 9% loss, worse than the 6.6% loss by the TSX benchmark including its dividends. After this big dividend paycheck and just past the halfway point, we are at $346.67. Before we continue, if you like this type of content, please smash that like button to spread this video to as many Canadian dividend growth investors as possible. It really helps our master, the YouTube algorithm. And if you want to follow our journey in our TFSA, why not hit that subscribe button and notification bell? Now back to what you came for. Our second pipeline to pay us this month was Enbridge. They provided us with $124.70 in dividends and represent 7.5% of our annual dividend income. This payment is drastically less than last quarter since selling some of our position. Despite the market finishing the year in a bad place, Enbridge finished the year up 14%, including its dividends. Not as impressive as Pembina, but still killing it. With its 3.2% dividend increase, it is now trading with a yield of 6.7%. While its 5-year average is 6.4%, pretty much in line with the past 5 years. After another big dividend check, we hit $471.37. Next, we were paid $45.32 in distributions from SmartCentres Real Estate Investment Trust. They now provide us with 7.9% of our forward annual dividend income as one of 2 stocks in the real estate industry as a retail REIT. They're trading above their 5-year average yield of 6.1% at a yield of 6.9%. SmartCentres finished the year down 11%, including its distributions, the worst of those that paid us in December. It is below my yield on cost, so I'll continue to add to this position. They have a 5-year dividend growth rate of 2.2%, matching inflation, but have not increased dividends since 2019, a few months before the pandemic. With this distribution, we run past the $500 mark to $516.69. For our 8th paycheck, we have our monthly financial payer, First National Financial. We receive $50.40. FN provides us with 8.7% of our annual dividend income. First National finished the year negative 6.6%, including its dividend. That is what the Canadian market average was. Currently, it provides a 6.6% yield. With a 5-year average yield of 5.6%, this is technically undervalued using this metric. By PE ratio, it is on the expensive side. I'm comfortable adding to this position despite the general sentiment about the real estate market in Canada and the rising cost of borrowing. As I always say, I like to accumulate fundamentally strong companies when they're out of favor or their industry or sector is as a whole. First National declared a small 2.1% dividend increase in October, bringing it to 20 cents a month. That makes it 1 decade of dividend increases and a 5-year DGR of 6.6%. This brings us to $567.09.
And now, for our largest holding, RioCan Real Estate Investment Trust.
And the crowd goes wild. Wah! They paid us a distribution of $62.29. This company provides us with a massive 10.8% of our forward yearly dividend income. It has a 5-year average dividend yield of 6.2%, which is drastically higher than the current yield of 4.8%. This is mainly due to RioCan slashing the dividend by 33% way back in 2021. The most recent dividend increase was 6.3% this year, or half a cent a month. What a roller coaster this year has been. RioCan finished the year down 3.5%, beating the market by 3%. I drip 2 or 3 shares every month, as this is a core holding for us. Q3 earnings were good, as I mentioned last month. I personally anticipate another modest dividend increase next year, inching closer to the previous distribution of 12 cents a month. Depending on the length and severity of a Canadian recession, I can see RioCan exceeding their target 10 to 12% return, in part because of how bad the outlook is for real estate. So after all 9 paychecks, our grand total is $629.38. Our top 3 dividend payments accounted for $310.92, or 49% of the $629.38 of dividend income for the month of December. This was almost $300 less than the previous year because of selling 30% of our portfolio in September. As we grow the portfolio, the top 3 should account for less of a percentage of our December income. I never want to be too dependent on any one company to help my portfolio grow in the event of a dividend cut. As you can see from the breakdown, no one industry or stock dominates our dividend income. Now, a huge part of our dividend income growth are the dividend raises we receive. We had 0 dividend increases this month. This broke our fabulous streak of 4 consecutive months. So sad. A few positions we recently sold off did have increases though, like CIBC Bank with a small 2.4% increase, or Toronto Dominion Bank with a 7.9% increase. TD will be back in the nest soon. Anyway, we finished off the year with $8,452.87 in dividends, with a yield on cost of 7.43%. Our top 3 dividend payers accounted for $1,992.15, or 23% of our total dividend income. Our forward annual dividend income has dropped from $9,500 to $6,910. With $60,000 of TFSA room in 2023, plus our dividends we will receive, we expect our dividend income to snowball just as fast as previous years. My little minions work hard for me, so I don't have to. With our minions working harder and harder each year, we can forecast where we will be in about 10 years. We hope to outpace this forecast as the TFSA contribution room grows in the future. We expect our TFSA account to bring in about $47,000 if we can keep up a 7% dividend growth rate. 2022 came in at a growth rate of just 6.4%, well below 2021. Can't wait to see what 2023 brings us. Thank you so much for watching, and stick with us for the journey in 2023. Until next time, I'm Mr. Financial.